I think the one thing that's been on everybody's mind since probably the September 19th high is what's gone on with Apple shares. We've obviously seen a huge decline, most recently last week with the big post-earnings drop. Talk a little bit about how this market has done what it's done in January without Apple being a part of it.
It's done very well without Apple. In spite of Apple, technology has gone up very well. The general market's gone up. Obviously, the cliff issues helped us. The lack of the sequester helped us. But Apple was always thought to take everything down. Starting about a year ago when they had that blowout fourth quarter in last January, and the stock went from 420 up to 600 in over in a little less than 2 months. Everybody was nervous about Apple coming down. What's going to happen? All the strategies, the exits, the way to sell them, the way to buy them. Okay, and it kind of lingered through and then hit that 702 mark on the September 19th that you said. But the market has been able to move past there. The fundamentals of the market are decent. They've got good balance sheets, earnings not great, but still coming in very well. Strong cash flow, good buybacks, good dividends, and the market has been able to move past Apple.
So that leads me right into my next question. Can this market keep going higher even if Apple doesn't participate? And the flip side of that question, if Apple does get on board, are we going to be really off to the races in this market?
Or if Apple gets on board, does the market go down?
You tell me.
We've got a lot of money coming into the market, and that's one of the items that's helped it a lot. Again, the end of the year, when the deal was cut and everything, there was a lot of relief there. No crisis, we've got some breathing room, and we're in earnings seasons. The market loves earnings seasons. They understand it, they know it, they don't have to worry about the politics of it. The company made it, didn't. You know, they go through the balance sheets operating as compared to as reported. So new money coming in has really been able to buoy this market and push in. The item here with Apple, though, is that not that much appears to have gone in on an individual basis. We hear a lot from the sell-side people how Apple's dealing with a 10, 11 PE, you've got 2.3% yield, great cash flow. If this was any other company, everybody would be running to buy it. But Apple has to beat the beat the beat. You know, everything has to be so much better. If people start going back into Apple and buying Apple at this point, not just the institutions who are in and out, you'll see a big move in that stock. I'm not saying that we're going back past that 702 that quick, but dealing from the 450 to 475 range, that is a very big stock with 940 billion shares there. It is going to be able to add a lot of market value, and that will add a lot of confidence back into a market that is starting to get confidence back at this point in time.
Now, you mentioned sort of individual investors, the retail class, and mutual fund managers too, hedge fund managers, people going back into this market. I want to go to those retail investors for a minute. We talk about the mutual fund flows as an indicator of what the retail investor is thinking. Well, we've seen outflows for a long time from equity funds, and we've started to see some inflows in a pretty significant way on a weekly basis to start this year. Hasn't replaced everything we lost over the previous 3 or 4 years, but money has started to come into this market. Is that a sign of an inflection point on the downside? Is it saying, hey, here come the retail guys, everybody else should get out of this market?
It's positive short term for the market, but yes, it is a longer term concern. Money appears to be coming out of fixed income. We've seen treasuries move up considerably, and the cash amounts coming in. We haven't seen anything like this since the old IRA seasons when everyone used to pull money out in January and February to put money into the old IRAs we're dealing 15, 20 years ago. So it is a concern that the masses could be buying into the market, and they're buying in because they may have more confidence, but it's not that they went in and they've done some cash flow analysis or PEs and they're checking on yields. Basically, they see the market, it's gone up very nicely. Last year was a 13.4% gain. We've got a 5.2 this month so far. So they see that and they want to get on the bandwagon. And that is a concern because they're getting on it because they're seeing yesterday's winners. Yesterday's winners is not necessarily today's winners.
Tell me a little bit about sort of a bull case, an optimist case for where we go, not in the next couple of weeks, because we maintain here at Forbes, we're looking long term. We're not necessarily saying here's what the market's going to do tomorrow, next week. We're talking about people who want to build wealth for their retirement, for the rest of their lives, save kids for their kids' college, those kinds of things. Long term, what's the bullish case here? What's the bearish case?
On the bear case, obviously, coming out of fashion was the old Japanese scenario that we would be stagnant. Now the more of a concern is that the Fed is pulling back. When you do pull back, can the economy hold on? But that's, to some people's view, a good point. When the Fed finally does pull back, it's like a child trying to walk. You're letting them go. Yes, they're going to fall a few times, but you want that child to be able to walk on their own. And the Fed's low interest rates is hurting the economy at some point, because while it attempts to stimulate it, it has to walk on its own. Also, interest income for a lot of people is hurting a lot. And the idea that you spend because rates are low as compared to spending because you believe in where the market's going and what you need. The bullish item over years is a lot easier. We go in cycles, obviously up and down. Earnings within the big cap issues have done very well. Emerging markets are still coming back to some degree, and the sales, there was a lot of people there. China, obviously, the whole Asian situation there. Europe should be coming back. They're past that point. So there's a lot of positive momentum.
Well, I said this before the end of the year, and I wrote stories about it. I find it hard to believe that people are going to abandon a stock paying a 4 or 5% dividend for a treasury bond paying 2% for less than 2% for 10 years. Just because there was a slight increase in taxes. And a lot of people hold those dividend stocks in tax-protected accounts.
Right, and the treasuries don't have the tax advantage. I mean, you have no city and state, but you get the full federal. The dividends, you do get a lot more on there. When I started at S&P, the dividend tax was 70%, and that was before New York City and state got hold of you.